Hello everyone, this is day 33 of the AS Economics Revision Challenge, and today we are doing causes and consequences of current account deficit. Before we talk about current account deficit, I would like to talk about macroeconomic goals that an economy has. When we look at macroeconomic goals, there are four macroeconomic goals we identify. Number one is what we call keeping uh, uh, inflation low, which is price stability, which is one macroeconomic goal. The second one is full employment. The third one is economic growth, which means basically GDP to keep on growing. And the last one is balance of payment stability. Now, 2 and 3 are basically topics that we will discuss in detail in A2 economics, but price stability and balance of payment stability is basically are the two topics that we have to discuss in AS. So this video will talk about the current accounts sort of deficit, which is basically the balance of payment stability. When we look at current account deficits, we need to discuss two things. One is what we call the causes of current account deficit, and the second one is consequences of current account deficit. So let's start with the causes of current account deficit. The first cause of current account deficit that we identify is to do with strong consumer demand for imports. So when you're a country which has a strong consumer demand for imports, you rely more heavily on imports for key inputs, or your consumers rely more heavily on buying imported goods, then that is basically a key reason why your current account remains in a deficit. Sometimes we say there could be a situation where a country could be importing very high amounts, which is causing what we call a continuous deficit on the current account. And this could be because what we say sometimes a higher propensity to import. What is propensity? Propensity means tendency to import. So sometimes some countries what we say have a higher propensity to import, which means if there is a rise in income, if income go up, we will see the demand for imports to rise. And that's exactly what we mean by higher propensity to import. So a rise in income leads to more imports to be bought, as there is a high what we call income elasticity of demand for imports. So a country may end up basically buying more of a good or buying more of imports when their income go up, and that's why these countries have what we call have high income elasticity of demand. So the first reason why a country may run into a current account deficit is basically strong reliance on imports. The second reason we identify why a country run into what we call a current account deficit could be basically our overvalued or strong exchange rate. If the exchange rate is too strong or overvalued, then this means that exports will be expensive and imports will be cheaper, and that can result in X minus M to fall. So net exports will fall in a country if the exchange rate is kept at a very high level, and sometimes that's why maybe depreciation or devaluation of the currency could be desirable to basically make the current account to improve. The third reason why you may see a country to run into a continuous current account deficit is basically when there is higher domestic inflation. A country's sort of exports in this case will be expensive, and as a result of this, because of the higher inflation and exports being expensive, a country may not be able to compete with cheaper imports. So higher export prices will lead to lower exports, and therefore a continuous current account deficit. So that's why keeping inflation low could be an important goal to achieve whenever a country is suffering from inflation. The next one is basically shift in comparative advantage. What is this basically? This is basically the idea that if a country runs into a current account deficit, it could be because they have lost comparative advantage. So a loss of comparative advantage can lead to lower demand for exports, which is a long-term fall of decline. For example, if you look at US car industry, currently it is going through tough times because the German and the Japanese have taken the comparative advantage, which previously at some point US also had. And also the growth of Chinese sort of manufacturing is on the basis of the fact that they have gained comparative advantage and other countries have lost comparative advantage. So whenever there is a loss of comparative advantage, we will see current account to run into a deficit. The next reason is basically to do with developing countries. Developing countries have two problems, which is where they run into current account deficits more often. Number one is that there is a limited domestic production and strong reliance on imports. So we look at Pakistan. Pakistan has limited domestic production when it comes to cars, when it comes to, for example, computers, when it comes to a lot of goods, and that's why there's a strong reliance on imports, because our consumers do not get domestic substitutes available. And the second point, which is important to understand, is this, that even key inputs are imported which are used for exports. Like currently, for example, Pakistan imports a high amount of oil, and that results in a current account sort of deficit, that its imports are strong. Now, can we reduce those imports? And the answer is it's very difficult, because there are no local substitutes available. So that's why sometimes developing countries run into a current account deficit. Let's now talk about how current account deficit has some negative consequences. So, what are the consequences of current account deficit? Well, one big consequence of current account deficit, which Pakistan currently is also facing, is the fact that reserves will run out. So, reserve of country may be used to regain balance in the current account deficit. For example, if you have a continuous current account deficit, you may take money away from sort of reserves and put it in the current account of your balance of payment to make it balance. Now, no country, no matter how rich and powerful, can run out of reserves if it is funding the long-term current account deficit. If you keep on funding your current account deficit with your reserves, there will come a point when your reserves will be extremely low, which is exactly what Pakistan is suffering right now. Very low reserves, primarily because the current account is in a continuous deficit for some years. The second consequence that we need to care about is basically, it may be that high level of buying of assets by foreigners is financing current account deficit. This means basically our financial account surplus is paying for the current account deficit. If the financial account surplus is paying for current account deficit, that's not a bad thing to happen. But what if there is a continuous deficit on the current account, and there is a continuous investment by foreigners in our assets? What's the problem with that? Well, then, for example, if too much of investment is happening from abroad, they start owning our assets, and there could be a loss of economic sovereignty. We could lose out our sovereignty or independent decision making, as the countries who control those assets will be making those decisions for us. Also, our policies may never remain independent, because then other countries may start influencing that. And also, another problem that happens is that, what if one country that has significant investment in your country suddenly decide to pull out or leave the country? That may result in a sharp decline in asset prices if investors exit. So, for example, if China right now is investing in Pakistan, if China decides to one day just pack their bags and leave, there could be a serious fall of prices and a serious decline in sort of investment in a country, and that could basically result in a huge uncertainty. So the fact that we are relying too much on foreigners sort of investment could be a problem for a country. Similarly, if there is high level of borrowing which is trying to fund the current account deficit, why is that a problem? Well, it could be a problem because there could be a loss of credibility if a country defaults. So if you keep on taking too many loans, there could be a possibility that you might end up defaulting. If you look at poor countries like, for example, Pakistan, it has a very high debt to GDP ratio. The high debt or loans or borrowings that you've done may end up causing a country to default, and if that happens, we lose credibility in the global market. Secondly, when you are borrowing so much, there could be high short-term interest payments that have to be paid, which means you will be taking money out from current account again to service those debts which you've taken in the past. In Pakistan case, that's also a case where current account deficit is also because of the loans that have been taken in the past. Lastly, there is what we call if a possibility of a contractionary fiscal and monetary policy done to fix the current account deficit. I'm going to talk about this in detail in the next video, where we talk about policies to fix current account deficit. But we need to mention this is that if a country ends up sort of doing what we call contractionary fiscal and monetary policy, then it could be very harmful for the economy in terms of employment and domestic demand. So if that is the case, then we may end up seeing problems in the economy. So the idea goes is that one of the consequences of a current account deficit is that a country may end up doing what we call contractionary fiscal and monetary policy, which sometimes is a last sort of resort. But if you end up doing that, there is a possibility of an economy to slow down and suffer from deflation because of this. The last discussion we want to have is basically, does current account deficit matter, or in other words, is current account deficit always harmful for a country or not? And the answer is not necessarily. If a current account deficit is, for example, small, which means if the size of the deficit is not so large, it's a small deficit as compared to a country's GDP. Let me write this, as compared to a country's GDP, then we say it's not a serious problem. Why? Because if your GDP is large, you can easily afford to pay your current account deficit if the country has strong GDP. But if a country has a very small sort of GDP, then the size of the deficit could be even a small deficit could be a problem, because you may have a repayment issue. So basically, it all depends on a country's GDP. If a country's GDP is large as compared to the deficit, then the size of the deficit may be really small and a country can easily repay. The second thing we care about when it comes to whether a country's current account deficit is a problem or is it harmful or not is basically continuity. The continuity argument basically is this, that if you have a current account deficit that is continuously happening for many years, then it could be a problem. But if it's only a short-term deficit for few years followed by surpluses, then it's not a problem. So if it's a short-term deficit for few years, we say it's not a serious problem. On the other hand, long-term deficit could be a serious problem, which is continuously happening for many years. The third one is basically cause of the deficit. If the cause of the deficit is because the country is basically sort of importing sort of machinery or capital goods, we say it's not a problem. Why? Because this will mean that there will be long-term economic growth. All the investment today can result in long-term economic growth. So if the cause of the deficit is because we're importing a lot of capital goods, machinery, infrastructure, then this may result in a short-term deficit but a long-term, basically long-term economic growth for an economy. So we need to look at why the cause of the deficit is happening. But if the cause of the deficit is, for example, a country buying consumer goods, it could be a serious problem. Last one is affordability. When we look at affordability basically means, is a country able to afford current account deficit or not? And the affordability matters because A, you could easily afford a current account deficit if you could have what we call high levels of reserves. If you have high level of reserves, then a current account deficit, for example, may not be problematic for you for some years. Similarly, what if your financial account is in a surplus? If your financial account is in a surplus, that is also good news for you, because if you have a current account deficit, financial account is prepaying or paying your current account deficit. And the last one is, a current account deficit may not be a serious problem if there is basically ease of borrowing. If a country has ease of borrowing, good credibility in the market, doesn't borrow too much, and if even if it borrows, it returns its money, then therefore there is a very high ease of borrowing, which means you could afford to have a current account deficit.